Guys, this is an urgent update. The gold and silver crash has exposed the entire system, and what just happened in the last 72 hours is going to change everything about how you think about markets, about the Federal Reserve, and about where money flows next. Because while everyone's focused on the carnage in precious metals, there's a massive rotation happening right under the surface that almost nobody is talking about. And by the end of this video, I'm going to show you exactly where that money is going and the specific stocks that could benefit as we move through earnings season. Now, before we dive in, the only thing I ask in return for all the work that goes into making a video like this is that you hit that like button and don't forget to subscribe. Every time you do that, YouTube pushes this video out to more people, which helps us prepare more people for what's happening in the markets. And if you want access to my best trade of the day based off a combination of market experience and algorithmic screeners that I use, plus daily recordings on market analysis that cover any questions you ask in the community, you can try my Discord, the Stocks Community, for just $25 for 7 days at stockscommunity.com. And if you're looking for a free resource, head over to free.stockscommunity.com, where you'll be able to sign up for my free newsletter and get market updates that I can't share here on YouTube due to the sensitive nature of the content, some of which involves government figures and their stock portfolios that YouTube can sometimes restrict on its platform. The link's in the description below. As always, if you're the one making the actual purchases and sells, you have to do your own diligence as well. Take your time, be cautious. This is not financial advice. I'm just sharing my research, and you have to make your own decisions. Now, let's get into it. Here's what just happened and why it matters more than people realize. Gold and silver just experienced the fastest collapse we've seen in over a decade. Not a gradual pullback, not a healthy correction, a violent flush that took out leveraged positions and shook confidence across the entire commodities complex. And the trigger wasn't some random technical breakdown. It was political, it was policy, and it was entirely predictable if you understood what was really happening behind the scenes. President Trump just announced his pick for the next Federal Reserve chair, Kevin Warsh. And the market's reaction to that announcement tells you everything you need to know about what investors were actually afraid of. Because the second that news broke, gold collapsed, silver got demolished, and suddenly all those people who were buying precious metals as insurance against dollar debasement and Fed recklessness had to reassess everything. Let me explain why this matters. For months, precious metals was a mania, and it built on one core fear, the fear that Trump would install a Fed chair who would do exactly what he wanted, cut rates to zero, print unlimited money, destroy the independence of the Federal Reserve, turn the dollar into toilet paper. That fear drove capital into gold and silver at an unsustainable pace. We saw 9 straight months of gains in gold and silver. Gold hit new all-time highs 8 days in a row. These weren't normal bull markets. These were panic moves, but Kevin Warsh is not the kind of Fed chair that fits that narrative. And that's why the market reversed so violently. Warsh has a history. He worked at the Fed during the 2008 financial crisis under Ben Bernanke. And during that time, he was one of the most vocal opponents of easy money policies. He argued against excessive quantitative easing. He warned about inflation risks when everyone else was focused on avoiding deflation. He resigned from the Fed in 2011 specifically to protest what he saw as dangerous money printing. Now, you might be thinking, wait, didn't Trump want low rates and easy money? Yes, and that's exactly why he didn't pick Warsh back in 2017. Trump almost chose Warsh then, but he passed on him because Warsh's track record suggested he would be too hawkish, too concentrated about the dollar, too willing to fight inflation even if it meant economic pain. So Trump chose Jerome Powell instead, thinking Powell would continue the easy money policies of Janet Yellen. But Powell didn't do that. Powell raised rates over 100 basis points in 2018. Trump got furious. He publicly demanded Powell's firing. And now, 8 years later, Trump is picking the guy he rejected before. Why? Because Warsh has supposedly changed. He's now saying he supports lower rates, but he's coupling that with language about tightening the balance sheet, about preserving the dollar's strength, maintaining some level of Fed independence. And that's what the market heard. The market heard, okay, maybe we're not getting the complete capitulation to Trump's demands. Maybe we're getting someone who will cut rates but won't destroy the currency. Maybe the dollar isn't going to collapse after all. And if the dollar isn't collapsing, why own gold? Now, let's be clear about something. Warsh's track record is not great. The guy was wrong about inflation for 17 years. In 2006, he was worried about core inflation at 2.1%. In 2007, same thing at 2%. In 2008, the day after Bear Stearns collapsed, he was still saying inflation was the biggest risk. The day after Lehman Brothers failed and the entire global financial system was imploding, Warsh said we need to fight inflation, not worry about growth. And what happened? We got deflation, massive deflation. The Great Recession didn't create inflation, it created the opposite. So Warsh has a history of seeing inflation problems that don't exist and being allergic to data. Other Fed officials literally described him that way, allergic to data. But despite all that, Wall Street sees him as credible, as someone who will protect the dollar, as someone who won't just print unlimited money to please the president. And that perception is what matters for markets in the short term, because markets don't trade on reality, they trade on expectations. And the expectations shifted from complete monetary chaos to maybe just normal bad monetary policy. That shift was enough to trigger the largest gold and silver sell-off in over a decade. Here's where this gets really interesting, because while everyone's focused on the precious metals crash, there's a much bigger story developing, the story of where capital goes next, because money doesn't just disappear, it rotates. And when fear trades unwind, growth trades come back. When safe havens get sold, risk assets get bought. And right now, we're seeing the early signs of a major rotation into technology and specifically into infrastructure, not software infrastructure, physical infrastructure, the picks and shovels of the AI revolution. And that brings us to the optoelectronics sector. This is a group of companies that most retail investors have never heard of, but they're critical to everything that's being built right now. Data centers, AI compute, high-speed networking, fiber optic communications, all of it runs on optoelectronics. Let me explain what optoelectronics actually means, because this is important. Optoelectronics are devices that convert electrical signals into optical signals and vice versa. Think lasers, photodetectors, optical transceivers. These are the components that allow data to move at light speed through fiber optic cables. And as data demand explodes from AI, from streaming, from cloud computing, the need for faster, more efficient optical components is going vertical. And we're in the middle of earnings season right now, which means these companies are reporting their results. And more importantly, they're giving guidance for what they expect in the coming quarters. And that guidance is going to tell us whether the AI infrastructure build out is accelerating or slowing down, whether hyperscalers like Amazon and Microsoft and Google are still spending massive amounts of money, or whether they're starting to pull back. So let me walk you through the 4 stocks that I think are the most interesting plays in this space right now. Applied Optoelectronics, ticker AAOI, Ciena Corporation, CIEN, Coherent, COHR, and Lumentum Holdings, ticker LITE. These are the names that are reporting during this earnings season, and each one has a slightly different angle on the optoelectronics market. Let's start with Applied Optoelectronics, AAOI. This is a smaller company that makes fiber optic networking products for data center interconnects. It's a pure play on data center optical networking. When hyperscalers build new data centers, they need optical transceivers to move data. AAOI makes those transceivers, and as AI workloads increase, demand for higher bandwidth connections goes from 100 gig to 400 gig to 800 gig. The risk is customer concentration, though. Huge portion of revenue comes from a few large customers. So if one cuts orders, stock gets crushed. But if they're ramping spending, AAOI can move significantly higher. Next is Ciena, ticker CIEN, much larger, more established. Ciena makes networking equipment for telecom providers and large enterprises. They're a leader in optical networking, strong positions in both service provider and data center markets. What makes Ciena interesting is multiple demand sources: AI data centers, 5G networks, fiber deployments, submarine cable systems. They're not a speculative bet. They're an established player with multiple tailwinds. Watch their order backlog and guidance during earnings. Then we have Coherent, ticker COHR, different from the others because they make lasers and optical components for many applications: industrial lasers, scientific research, and communications networks. They recently merged to create a much larger company. There's execution risk from that integration, but also opportunity. The bull case is exposure to multiple secular growth trends, including silicon photonics, which could revolutionize how data moves inside and between chips. Finally, Lumentum, ticker LITE, another pure play on optical communications. They make transceivers, lasers, and components for data centers and telecom. They also have 3D sensing exposure for smartphone applications, strong position in high-speed optical transceivers as data centers upgrade to 400 gig and 800 gig. Lumentum benefits. They're diversifying their customer base and investing in next generation products. Now, let me tie all this back to the macro picture because that's what really matters. The gold and silver crash wasn't just about Kevin Warsh. It was about a broader shift in market psychology. For months, investors were pricing in worst case scenarios: dollar collapse, Fed capitulation, runaway inflation. That drove capital into safe havens, but now the narrative is changing. Warsh's appointment suggests that maybe the Fed won't completely destroy the dollar. Maybe there will be some discipline. Maybe we're not heading into hyperinflation. And if that's true, then growth assets become more attractive than defensive assets. Tech becomes more attractive than gold, and infrastructure plays become more attractive than precious metals. This is why the optoelectronics sector is interesting right now, because if the market's rotating from fear to growth, then the companies that enable that growth should benefit. And the companies that enable AI and data center expansion are exactly these optical networking firms. Now, let's talk about the risks, because there are plenty. Risk number one: what if the AI spending boom is overhyped? What if companies have overbuilt and they need to digest capacity before ordering more equipment? That would be bad for these stocks. We've seen this pattern before in telecom, where everyone builds out infrastructure and then demand doesn't materialize and the stocks collapse. Risk number two: what if Kevin Warsh actually is as hawkish as his history suggests? What if he comes in and tightens monetary policy more than expected? That would be bad for risk assets in general, and especially bad for high growth tech stocks. Higher rates mean lower valuations for companies that are priced on future earnings. Risk number three: what if China floods the market with cheap optical components? China has been investing heavily in this technology, and if they start dumping products at below market prices, that would pressure margins for US companies. We've seen this in solar panels, we've seen it in other industries. It's a real risk. Risk number four: customer concentration. A lot of these companies derive significant revenue from a small number of hyperscale customers. If one of those customers cuts spending, it can have a huge impact on the stock. And we've seen this happen before. Amazon decides to slow data center build out for a quarter, and suddenly the whole supply chain gets hit. So these are not risk-free investments, but nothing is. The question is whether the risk reward makes sense. And right now, I think it does for a few reasons. First, the AI infrastructure build out is real. It's not hype. Companies are actually spending money. Data centers are being built, and those data centers need optical networking gear. Second, the technology is advancing. We're moving from 100 gig to 400 gig to 800 gig. These are upgrades. It's this whole cycle, and upgrade cycles create demand even if the overall number of data centers isn't growing that fast, because existing facilities need to be retrofitted with the faster gear. Third, the valuations are not crazy. These stocks have been beaten down over the past year. They're not priced for perfection. So if the earnings reports come in decent and guidance is okay, there's room for additional moves to the upside. Whereas with gold and silver, the valuations were stretched insanely. The sentiment was overly bullish, and that's why the reversal was so violent. Now, let me talk about the actual mechanics of how to play this, because just buying these stocks randomly is not a strategy. You need to understand what you're looking for in the earnings reports, and you need to plan for how to react based on what the companies say. First thing to watch is revenue growth. Are these companies growing their top line, and is that growth accelerating or decelerating? If revenue growth is accelerating, that's a good sign. It means demand is strong. If it's decelerating, that's a warning sign. Even if absolute numbers are okay, if the trend is slowing, that's a problem. Second thing to watch is gross margins. Optical components can be a tough business because there's pricing pressure from customers and competition. If gross margins are holding up or expanding, that means the company has pricing power. If margins are compressing, that's a red flag. Third thing to watch is inventory, both the company's inventory and their customers' inventory. If the company is building inventory because they expect strong demand, that's fine. But if they're building inventory because sales are slowing, that's bad. And if customers are sitting on excess inventory, that means future orders will be weak. Fourth thing to watch is guidance. This is the most important. What's management saying about the next quarter and the rest of the year? Are they optimistic? Are they cautious? Are they seeing strong order flow? Or are customers pushing out deliveries? The guidance will tell you whether the momentum is continuing or stalling. And fifth, listen to what they say about end markets. Are the hyperscalers still spending? Are telecom providers accelerating fiber deployments? Are there any new customers or new applications driving demand? The more diverse and robust the demand picture, the better. Now, let's talk about position sizing because this is critical. These are not stocks you bet the farm on. They're volatile, they're subject to sudden shifts in customer behavior, and they're in a sector that has historically been boom and bust. So you need to size your positions appropriately. If you're going to play the sector, I would suggest making it a small to moderate portion of your portfolio, maybe 5 to 10% across all four names. And within that, you might weight towards the larger, more established companies like Sienna and Coherent, and have smaller positions in the higher risk, higher reward names like AAOI and Lumentum. You also need to have stop losses. These stocks can gap down on earnings if the numbers disappoint, so you need to protect yourself. I'm not going to tell you where to set your stops because that depends on your risk tolerance, but you should have them and you should honor them if they get hit. Another approach is to wait for the earnings reports to come out. That's what I recommend. See what the companies say, see how the stocks react, and then decide if you want to get involved. The disadvantage of this approach is that if the news is good, you might miss some of the initial move, but the major advantage is you have more information. You're not guessing, you're reacting to actual data and the earnings reaction. I think the best approach is a combination of you take a small starter position before earnings if you're really convicted, and then you add to it if the report and the reaction is good. Or you cut if the report's bad. You have some exposure to the upside, but you're not overcommitted if things go wrong. Now, let me tie this back to the bigger picture one more time because I don't want you to lose sight of the forest for the trees. The gold and silver crash is telling us something important. It's telling us that the market is reassessing risk. It's telling us that the fear trade is unwinding. And it's telling us that capital is looking for the next opportunity. That next opportunity might be in AI infrastructure, might be in optoelectronics, or it might be somewhere else entirely. But the key is to be aware that rotations are happening. Capital doesn't sit still, it moves. And you can identify where it's moving before everyone else figures it out. That's where you make money. The Kevin Warsh appointment is significant, not just because of what it means for the Fed, but because of what it reveals about market psychology. Investors were so scared about dollar collapse that they pushed gold and silver to unsustainable levels. And now that fear is unwinding. And as it unwinds, other opportunities emerge. But don't get just relaxed. This isn't a signal to go all in either. We're in an uncertain environment. The Fed is still navigating a difficult path. Interest rates are still higher than they were a few years ago. The economy is still dealing with the after effects of all the money printing from COVID, and there are geopolitical risks everywhere you look. So yes, the optoelectric center could be interesting. These earnings reports could provide catalysts, but you still need to be disciplined. You still need to manage risk in this sector, and you need to have a plan for different scenarios. Let me also address the Bitcoin angle briefly because it's relevant. Bitcoin sold off along with gold and silver, and a lot of people are confused about why, because Bitcoin's supposed to be different. It's supposed to be digital gold, but it's also a risk asset, and when risk asset appetite shift, Bitcoin gets affected. And the reality is Bitcoin's too small to absorb the kind of sovereign flows that gold absorbs. As Jack Mallers has pointed out, China's trade surplus alone is larger than Bitcoin's entire market cap. So when countries need to park trillions of dollars, they go to gold because it's big enough and liquid enough. Bitcoin will get there eventually, but it's not there yet. So Bitcoin sold off, and not because the thesis is broken, but because it's competing with equities and risk assets, not with sovereign paper. It responds to actual liquidity, not anticipated liquidity. And right now liquidity is tight. But if the Fed does start easing and if the balance sheet starts expanding again, Bitcoin will benefit. It just needs the actual money printing to happen, not just the talk of it. And that brings me to my final point. Everything we're seeing right now is about timing and sequencing. Gold and silver moved first because they front run liquidity. They anticipate what's coming. Bitcoin and risk assets move later when the liquidity actually hits the system, and optoelectronics and infrastructure plays move when companies actually deploy capital into building things. So the gold and silver crash doesn't mean the bull market's over. It means we're in a different phase, a phase where defensive assets pull back and growth assets start to catch up, a phase where the market is betting on economic activity instead of economic collapse. It's a phase where stock pickers can potentially outperform by finding the companies that are actually benefiting from the structural trends. The optoelectronics sector is one area to watch, but it's not the only area. There are opportunities in energy infrastructure, in utilities, in materials, in industrial companies, even in memory continuing. All of these could benefit if the market's rotating from fear to growth, but you have to do the work. You have to understand the companies. You have to watch the earnings reports. You have to manage your risk, and you have to stay disciplined because markets will try to shake you out. They will create volatility that tests your conviction. And if you're not prepared, you'll make emotional decisions that cost you money. So here's my advice. Watch these earnings reports closely. Listen to what management teams are saying. Look for companies that are seeing strong demand and giving confident guidance. And when you find those companies, consider taking positions, but size them appropriately, use stops, and have a plan for both the upside and the downside. And remember, this is not about getting rich quick. This is about positioning yourself to benefit from structural trends that play out over quarters and years. The AI infrastructure build-out is real. The demand for optical networking is real. And the companies that can execute in this environment will create a lot of value for shareholders. But there will be volatility, there will be setbacks, and there will be times when you question whether you're right. That's normal. That's part of investing. The key is to stay focused on the fundamentals, on the actual business results, on whether demand is growing and companies are executing. If those things are true, the stocks will eventually follow. And if you want access to my best trade of the day based off a combination of market experience and algorithmic screeners that I use, plus daily recordings on market analysis that cover any questions you ask in the community, head over to stockscommunity.com. Join my Discord, the Stocks Community, for just $25 for 7 days. We break down earnings reports like these in real time every single day. Plus, if you want the full transcript of this video and future videos, sign up at free.stockscommunity.com. The link is in the description below. So, what do you think about this rotation? Do you think the gold and silver crash is the beginning of a broader shift into growth assets? Do you think the optoelectronics sector has room to run? Let me know in the comments. I love hearing from you, but that caps off the video. If you found this valuable, smash that like button, subscribe to the channel, share this with somebody who needs to hear it, because the rotations are happening right now, and the people who understand what's going on are going to make a lot of money in 2026.